In Arizona real estate transactions, understanding the difference between pre-qualification and pre-approval is critical. Both buyers and real estate professionals benefit from clear expectations, proper documentation, and early identification of financial issues. When handled improperly, financing misunderstandings can derail contracts, create legal liability, and cause frustration for all parties. Understanding pre-qualification versus pre-approval. Definition of pre-qualification. Pre-qualification is an informal estimate of a buyer's borrowing potential. It is based on verbal or self-reported financial information and does not involve documentation or a credit pull. Key features: no credit check, no documentation submitted, offers a rough idea of purchase power, useful for early-stage planning, not for submitting offers. Definition of pre-approval. Pre-approval is a formal, document-based commitment from a lender that the buyer meets basic lending criteria, subject to conditions. Key features: credit report is pulled and reviewed. Buyer submits pay stubs, tax returns, and bank statements. Income and assets are verified. Lender provides a conditional approval letter, often used when making offers. Why this distinction matters in Arizona real estate. Presenting a pre-qualification letter as a pre-approval can mislead the seller and violate ARS, paragraph 32, 2153A3. Failing to distinguish between the two may result in contract fallout, delays, or licensee discipline. AAC R4 28 1101B. Licensees must promote and protect the client's interest honestly and fairly. Ensuring the buyer is genuinely pre-approved before writing an offer is an extension of this duty. Common issues with buyer financials. Even with a strong pre-approval, buyers may face challenges that impact loan eligibility. Understanding these common issues can help agents guide clients toward solutions before they cause problems during escrow. A. Credit concerns. Low credit scores, below 620, may limit loan options or trigger higher interest rates. Derogatory marks such as late payments, collections, or charge-offs can require explanation. Disputes or identity errors on the credit report can delay underwriting. Example: a buyer is denied final loan approval due to a recent 90-day late car payment that was unknown to them. A credit pull during pre-approval could have revealed and addressed this sooner. B. Income discrepancies. Self-employed or 1099 income can vary significantly year to year. Commission-based income requires a history of consistent earnings. Underreported income on tax returns can reduce qualifying income, even if bank deposits are strong. Example: a hairstylist reports earning $60,000, but tax returns show only $34,000 in taxable income due to deductions. Lenders qualify based on reported income, not gross receipts. C. Asset verification. Unseasoned funds, money deposited within the last 60 days, may require a paper trail. Large unexplained deposits could be viewed as loans, not acceptable assets. Cash gifts must be documented with a gift letter and donor verification. Example: a buyer uses a $10,000 cash gift from a friend for a down payment, but has no documentation. The lender rejects the funds, causing a delay and potential loan denial. Troubleshooting problems. Early. Many of these challenges can be prevented if agents take steps early in the transaction. Involve a lender. Early encourage buyers to begin the pre-approval process before house hunting. Early review of income, credit, and assets can uncover issues and provide time to correct them. Educate buyers on the paperwork needed. Help buyers compile a checklist of basic documentation. W-2s or 1099s, 2 years. Pay stubs, last 30 days. Tax returns, 2 years. Bank statements, 2 to 3 months. Government-issued ID. Example: an agent shares a lender's document checklist with a new buyer who discovers their tax returns show inconsistent income. The buyer works with a CPA to amend or clarify before making offers. Spot red flags. Employment changes within the last 60 days. Unverifiable side income. High DTI ratios revealed in early discussions, AAC, R4-28-1101F. Licensees must deal fairly with all parties and disclose material facts. A buyer's financial limitations or recent job loss is a material fact if it impacts the likelihood of closing. Legal and regulatory considerations, Arizona focus. Regulation application, AAC, R4-28-1101B. Protect client interests with honesty and integrity. Includes financial accuracy. AAC, R4-28-1101F. Disclose all material facts that affect a party's ability to perform. ARS, paragraph 32-2153A, 3. Misrepresentation, including overstating a buyer's readiness, can result in disciplinary action. Realtors are Code of Ethics, SOP 116. Realtors are must advise buyers to obtain pre-approval as part of responsible due diligence. Case scenarios and preventive strategies. Scenario: loan denied after contract acceptance. A buyer with seasonal self-employment income is pre-qualified but not pre-approved. They go under contract on a $450,000 home. During underwriting, the lender finds inconsistent income across tax years. The buyer doesn't qualify, and the deal falls through. Lessons for agents. Don't rely on verbal pre-qualification for offer submissions. Help clients understand income verification for self-employed borrowers. Document your recommendations in writing. Agent best practices. Build strong relationships with reliable lenders who communicate clearly and respond quickly. Review lender letters to ensure they're current and truly pre-approval, not just pre-qualification. Educate buyers on timelines, expectations, and possible roadblocks. Avoid offering lending advice. Stay within the scope of your license. Example: an agent refers a new buyer to 3 lenders. One finds a credit discrepancy, which is resolved before any offers are written. The buyer becomes fully pre-approved, and the agent helps submit a winning offer backed by verified financial readiness. Distinguishing pre-approval is part of professional practice. Helping your client understand and obtain true pre-approval is more than a smart business move. It's a legal and ethical duty. As a licensee, you are responsible for disclosing material facts, including buyer readiness. Required to stay within the scope of your real estate license. Expected to encourage due diligence to prevent transaction failure. By partnering with lenders early, identifying common red flags, and educating buyers with clarity, you serve your clients with professionalism and ensure greater success in your real estate transactions.